One of the companies that has made a huge financial turnaround over the last couple of years is Uber. The company burned billions of dollars, not only when it was in its startup phase, but even after it was a public company for a while. Obviously, going through the pandemic was a downtime for the company, but in the last year, it's actually made a nice profit. And this has come as a surprise to a lot of people who thought that this was going to be a money losing business long term. So there are a few factors that go into Uber's newfound profitability, but there's one that is more important than anything else. That's what I'm going to get into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And before I get to the most important number for Uber, I want to just go through some of the financials because this is really key when looking at the company. This is a look at the company's total revenues and net income. You can see that revenue has just exploded over the last couple of years. 2022 was a very strong year, and then the trailing 12 months, which includes the final quarter of 2022, that growth continues. The company's revenue has more than doubled since 2021, and it's up almost 3x since 2019. That would be the year before the pandemic. And you can see that net income was negative $8.5 billion during 2019, a huge turnaround in the company's financials. So what is driving this? Well, there are three segments to look at. The orange segment is the mobility revenue. That's what we traditionally think of as Uber. This is people picking up riders in their own car, black car service, all of the things that Uber was originally built on. The growth driver over the last 5 years has really been the delivery revenue. So this is Uber Eats and all the other delivery services that Uber has. You can see that that's gone from $587 million in revenue in 2017, now a $12 billion revenue in the past 12 months. Freight revenue is also a big contributor, $5.5 billion in revenue just in the past year. So these are the growth drivers that Uber has in its business, and this is what is moving the top line. These revenue pieces are really driving Uber's position in the market, beating a company like Uber or competitors like DoorDash. When you have scale, you're able to use that to your advantage in a number of different ways. If you know that drivers are available to pick up people, to pick up orders, then you're going to have enough supply in the market when customers demand some sort of service. If there's enough demand, then you're going to be able to attract more supply. This is really the network effect that we have seen happen between a lot of these competitors. And this is why Lyft has fallen off as Uber has been able to grow their revenue and even grow their bottom line. But really, the bottom line is driven by one number, and I'm going to get to that in just a second. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Uber's net income is really driven by what we call the take rate, or the percentage of each dollar spent on the Uber platform that Uber generates as revenue. When you go for a ride, if it costs $20, the driver doesn't get $20. The driver gets, sometimes it's $10, sometimes it's $15. It really varies depending on the ride. It's not necessarily consistent, but on average, Uber is going to take a little over a quarter of every dollar that you spend on their platform. And these are the numbers right here. You can see how the take rate has changed. 2019, the take rate was only 20%. Now that dropped in 2020, in 2021, as you might expect. When we were going through the pandemic, Uber wanted those drivers that they still had to be able to make a living. So they reduced their take rate to help out drivers, but that has really reversed over the last couple of years. There's a number of reasons for this. One, we have seen competitors like Lyft kind of fall off. That has given Uber a little bit more pricing power. The market has also demanded that Uber start to show that it can be profitable. So it has done that by increasing this take rate. That take rate has been over 28% in the last year and a half and is now standing at about 27%. So that is the real reason that Uber's revenue and net income have both improved as much as they have in just the last couple of years. You can do a lot to this business if you're increasing the take rate. And the other thing to consider with this number is the portion that Uber does not take that is shared with suppliers, whether that's drivers, whether that's restaurants, they don't count as revenue. So if Uber is generating $30 billion in revenue, then that means that there's about $100 billion in economic activity that are going through the system. $70 billion of that is going to their partners. So that's just worth understanding when looking at their revenue, because the revenue recognition for a company like this is really important. Now, the question is whether these trends can continue. And there's a couple of things that I'm watching related to that. One is Uber going to face competition from other adjacent companies that are essentially doing the same thing? Lyft would be a natural competitor in the mobility segment. You have companies like DoorDash in the delivery segment. Uber's advantage is that it really plays across all of these markets. But if any of these niche suppliers really start to take a lot more market share, then that could threaten Uber's ability to keep that take rate where it is and even the revenue that they're generating. So that's something to keep an eye on. The other thing that I'm really watching closely is autonomy. Now, Uber has a partnership with Waymo, basically white labeling autonomous vehicles in the Phoenix area right now. But there are at least two more competitors to keep an eye on. Cruise, which is actually off the roads right now, but sounds like they're going to be coming back on roads in Texas or in Arizona relatively soon. But that's another autonomous driving company, could really impact the mobility segment because they're able to scale those, don't have to pay for drivers. Instead of take rate being important, the autonomous driving company actually takes 100% of the revenue. So that's a company to keep an eye on that's owned by General Motors. And then the other one is Zoox. Zoox is another company very similar to Cruise and Waymo, developing fully autonomous vehicles, and they're built specifically for ride sharing. This is a company that is owned by Amazon. So again, lots of questions about when they're going to launch, what the business model behind them is going to be. But there's plenty of money behind a company like Zoox because of their owner. And if they have the technology to scale this both in the US and then around the world, this could be a big competitor to Uber's business, which is still reliant on those drivers. And then the final thing to think about when we think about autonomy is Uber going to be able to make some sort of transition? Even if they do have a great deal with Waymo, even if they acquired Waymo, how do you transition from having drivers be the suppliers that you're really building your business upon to having enough autonomous vehicles where you can actually build an autonomous ride sharing service or an autonomous delivery service? I don't think there's a clear answer to that either. So Uber is taking a lot of steps in the right direction, but the biggest reason that it has become profitable recently is increasing that take rate. So we'll see if there's any pushback on that, specifically from drivers and from restaurants. I know that we have seen a lot of complaints from drivers that they're maybe not making as much money as they used to. Restaurants are actually starting to pass on those added costs that Uber is taking by increasing their prices. If you have used Uber Eats recently, you probably know that you're going to pay more on Uber Eats than you would just picking up the same product in the store. But for investors, I think it's important to understand these dynamics and exactly how they play into where the company is going long term. So Uber has done a phenomenal job at taking the market leading position and has the scale to beat back competitors like Lyft. I think even DoorDash is in a challenging position. Now we're going to have to see what happens with something like autonomy. Is that competition that Uber is going to be able to face head on and adjust to? We will see in time. But what do you think about Uber's position? Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.